With the market for Tilray Brands Inc. currently closed, the stock concluded its most recent trading session on Friday, September 19, 2025, at a price of $1.21. This represented a notable intraday decline of 3.97%, a move that encapsulates the volatility and precarious sentiment currently surrounding not just Tilray but the entire cannabis sector. While a single day's movement is just a snapshot, this dip below the previous close of $1.26 hints at a much larger and more complex narrative, one where the prevailing market expectation of a straightforward path to profitability and regulatory clarity clashes sharply with a far more turbulent reality. Investors and analysts are caught in a tug-of-war, with bullish hopes for U.S. federal legalization and international expansion on one side, and the harsh realities of persistent net losses, regulatory setbacks, and intense market competition on the other. The immediate assumption might be that any negative movement is tied to a company-specific misstep, but the truth is far more nuanced, woven into the very fabric of a nascent and politically sensitive industry. The recent pressure on the stock is not an isolated event, but rather a symptom of broader market anxieties, particularly following a recent Department of Justice decision to cancel pending cannabis rules, injecting a fresh dose of uncertainty into the long-awaited U.S. market entry. The common belief surrounding a company like Tilray is that its destiny is inextricably linked to the whims of legislators. The expectation is that once the federal floodgates open in the United States, a company with Tilray's scale and international footprint will inevitably dominate. This narrative has been the primary driver for many retail and institutional investors, a simple yet powerful story of being early to a multi-billion-dollar industry. However, the deeper reality is that Tilray's success is not a foregone conclusion, even with full legalization. The company is navigating a complex financial landscape marked by significant operating losses and the looming threat of delisting from the Nasdaq for failing to maintain a minimum bid price, a concern so pressing that management is actively considering a reverse stock split. This move, while technically a solution to a compliance issue, often signals underlying weakness to the market, further complicating the investment thesis. The tension here is palpable. The grand expectation of a cannabis titan clashes with the present reality of a company burning through cash and fighting to maintain its place on a major exchange. This isn't just a story about future potential, it's a story about current survival and the strategic pivots required to bridge the gap between the two. Diving deeper into the recent stock movement, the daily swings are not random noise, but reflections of this ongoing battle between hope and fear. The stock has been highly volatile, with a 52-week range stretching from a low of $0.35 to a high of $1.85. This wide variance underscores the speculative nature of the investment. Trading volumes have been substantial, often exceeding 30 million shares in a single session, indicating a high level of engagement from both retail traders, perhaps drawn in by platforms like Robinhood or SoFi Invest, and more sophisticated institutional players. Analysis of institutional ownership reveals a mixed bag. While hundreds of institutions hold positions, their conviction appears to be wavering, with some notable funds reducing their exposure. This institutional skepticism is a critical piece of the puzzle, suggesting that the smart money is hedging its bets, waiting for more concrete evidence of a sustainable business model. The market's reaction to recent news has been equally telling. Positive announcements, such as Tilray's expansion of its medical cannabis offerings in Germany or strategic partnerships for its beverage brands, often provide temporary lifts. However, these gains are frequently erased by broader sector headwinds or disappointing financial results. This dynamic creates a choppy and unpredictable trading environment, frustrating for long-term investors seeking steady growth and tantalizing for short-term traders capitalizing on the volatility through platforms like interactive brokers. To truly understand Tilray, one must look beyond the cannabis leaves. The company has embarked on a significant diversification strategy, a move born out of necessity to create revenue streams independent of the volatile and unpredictable cannabis market. Tilray has aggressively expanded into the alcoholic beverage industry, acquiring several craft beer brands like Sweetwater Brewing Company and Breckenridge Distillery. This strategy is not merely about adding revenue. It's a deliberate attempt to build a consumer packaged goods powerhouse, leveraging existing distribution networks and brand-building expertise. The expectation is that these established cash flow positive businesses can provide a stable foundation while the cannabis division matures. The reality, however, is that integrating these acquisitions and competing in the highly saturated craft beverage market comes with its own set of challenges and costs. Furthermore, the company has a wellness segment centered around its Manitoba Harvest brand, which offers hemp-based food products. This three-pronged approach, cannabis, alcohol, and wellness, is Tilray's answer to the market's demand for a clear path to profitability. It's a strategic hedge, an admission that the cannabis dream alone may not be enough to carry the company in the short to medium term. Many investors who initially bought into a pure-play cannabis story may now find themselves holding shares in a diversified consumer goods company, a fundamental shift in the investment thesis that requires careful consideration. Whether this diversification is a stroke of genius or a desperate attempt to stay afloat is the central question that will determine Tilray's future. For those managing their portfolios through services like Schwab Intelligent Portfolios or Fidelity Wealth Management, this strategic shift complicates the sector allocation and risk profile of the stock. Looking ahead, the future of Tilray Brands is a tapestry of potential catalysts and significant risks. The most powerful catalyst, without question, remains the potential for U.S. federal cannabis legalization or rescheduling. Such a move would not only open up the world's largest consumer market, but would also alleviate crushing tax burdens under IRS Section 280E and grant access to traditional banking and financial services, a game-changer for the entire industry. This is the grand prize, the event that bulls have been anticipating for years. On an international level, continued growth in the European medical cannabis market, particularly in Germany, presents another significant opportunity. Tilray has positioned itself well to capitalize on this trend, with established operations and a growing portfolio of EU GMP-certified products. The company's beverage alcohol segment also holds potential for organic growth and further acquisitions, solidifying its position as a diversified consumer brands company. Comment below with your prediction. Will the U.S. federally reschedule cannabis before the end of 2026? However, the path forward is fraught with peril. The most immediate risk is the company's ongoing struggle with profitability. Consistent net losses raise concerns about cash burn and the potential for further shareholder dilution through capital raises. The regulatory environment, even outside the U.S., remains a complex and ever-changing landscape. Any unexpected shifts in policy in key markets like Canada or Germany could negatively impact operations. Competition is another major threat. The cannabis market is becoming increasingly crowded, with numerous players vying for market share, leading to price compression and margin erosion. In the beverage sector, Tilray faces off against established giants with deep pockets and extensive distribution networks. Finally, the macroeconomic environment poses a risk. High inflation and rising interest rates can dampen consumer discretionary spending, affecting sales of both premium cannabis and craft beverages. An economic downturn could further pressure a company that is already in a precarious financial position. In conclusion, the narrative of Tilray Brands is a classic tale of expectation versus reality. The market's expectation has long been centered on a simple, powerful idea: the inevitable boom of the legal cannabis industry and Tilray's ascent as a global leader. The reality is a far more complex and challenging journey. The company that exists today is not a pure-play cannabis venture, but a diversified consumer goods company grappling with significant financial pressures, intense competition, and a volatile regulatory landscape. The closing price of $1.21 is more than just a number. It is a reflection of this profound tension. It represents a market struggling to price in the immense potential of federal legalization against the stark reality of current financial performance and regulatory uncertainty. The diversification into alcohol and wellness is a pragmatic, perhaps even necessary pivot, but it fundamentally alters the investment case. The ultimate success or failure of Tilray will depend on its ability to navigate this intricate reality, to achieve profitability in its existing businesses while remaining agile enough to seize the transformative opportunities that may lie ahead in the cannabis sector.
The story is far from over, but it has become clear that the path to success will be neither straight nor simple.